Thank you for joining me once again for our third installment here of Accounting for Non-Accountants. In today's lesson, what we're going to do is take a look at the balance sheet, which is another one of the fundamental financial reports that really any organization that you work for is going to keep. Okay, so the general purpose of the balance sheet is to keep track of the balances in your asset accounts, your liability and equity accounts. Okay. Fundamentally, on the balance sheet, it's going to be divided in the following way. You're going to have your assets section. In the statement on the right-hand side, you see the assets are listed on the left-hand side of the report, and the liability and equity accounts are listed on the right-hand side of the report. Okay. One thing to take notice of is that the sum total of your assets, in this particular example, $910,000, is going to be equal to the sum total of your liabilities and equity. Okay. That's one of the kind of fundamental accounting equations that you should commit to memory, that assets is always equal to your liabilities and your equity. Okay. As it relates to how the accounts are kind of subdivided, what we're going to see on the asset side of the house is that your assets are going to be divided into your current assets, your long-term or fixed assets, and intangible or other assets. Okay, so your current assets are going to be those assets that you anticipate turning over and turning over to cash within a 12-month time frame. Your long-term or fixed assets are assets that you anticipate residing on your books in excess of a year. So this is oftentimes going to be long-term investments. This is going to be your property, plant, and equipment would be another example of a long-term asset. Then your other assets might be kind of miscellaneous things such as goodwill, other types of miscellaneous receivables, or other common forms of other assets. Okay. In a likewise manner, over on the liability side of the house, you'll also see that your liabilities are typically going to be divided into current liabilities as well as long-term liabilities. So your current liabilities will include your accounts payable, which is debt that is due to your suppliers and vendors. You might have various types of accruals that you do for expenses and inventory that's going to fall in the current liabilities section. Liabilities due to your taxing authorities will oftentimes fall in this section also. Okay. Long-term liabilities oftentimes are going to be notes or different types of bank loans that the organization is going to be paying off over the course of many years. Those will make up your long-term liabilities. Then the equity section of your balance sheet typically doesn't have that many line items on it. It's just kind of it's generally all grouped together into common stock, preferred stock. If you're a public organization, you'll have owner's equity, and retained earnings will also appear therein. Okay. So let's go ahead and step through these sections of the balance sheet so we can have an understanding of what all these different accounts represent. So starting off in your current assets section, as I indicated, these will be assets that are going to be turned over within the course of the year. The very top line of the assets section is going to be your cash accounts. Okay, so the cash is going to represent, just like you have in your personal finances. You have a bank account. With your personal financing, you'll have a checking account typically and a savings account. So very similar principles as it relates to corporate cash. Oftentimes you'll see within organizations they'll have an operating account. Okay, so this is going to be the bank account that they make payments to their suppliers, and the bank account into which they receive monies from their customers. Some organizations will have these broken up into two separate accounts. So you'll have like a deposit or lockbox account, then you'll have an account from which you do disbursements. Okay. Oftentimes organizations will have a separate account for their payroll. Okay, so if they issue out, if they pay their employees every 2 weeks, they'll set it up that they'll withdraw funds from their operating account, move that into the payroll account, then pay their employees out of that account. So oftentimes the payroll account will maintain a zero balance. Just having funds in there sufficient to cover the needs of that current payroll period. The organization might have an investments account, okay? And sometimes you'll also see an account referred to as petty cash. So this might be, represent a little bit of funds that the organization just keeps on hand at the company. Maybe they keep it in a safe or a locked desk drawer. And this is going to be used for, small purchases. Maybe, if the manager wanted to bring in, order in lunch for a particular meeting, he could use funds out of the petty cash drawer to, pay for that expense. So, it's going to be, the activity in that account's usually pretty small. Okay. Cash is very important to the organization because it represents, the primary source of liquidity for the business. So, the business wants to have a strong cash position so that it can be in a comfortable spot to pay off all the debts that the organization is incurring. Okay, so you need to have cash on hand to pay your suppliers. You need to have cash on hand to pay your employers. Some organizations will take out a working line of credit with their bank just so they have a safe cushion there, so they know that they can always meet these current liability needs. Okay. As it relates to that, there's a couple different metrics or a couple different ratios here that managers, credit managers, and so forth will look at to make sure that they're in a strong position, that the company's not overly leveraged. It doesn't have more debt than what it has cash or assets on hand to cover. So one important ratio that you'll oftentimes see in businesses is referred to as a current ratio, which is going to be your total current assets divided by your total current liabilities. So again, your current assets representing your cash, your accounts receivables, your inventory, all these things that are either in the form of cash or will be shortly turned over into cash. Then the denominator there, the current liabilities, represents your accounts payable, your current debt on bank loans and so forth. So with that current ratio, if your cash on hand and your receivables and everything is very small, you might have a current ratio less than 1, which isn't a good thing. On the flip side of a coin, you don't want to have, sometimes it can't be advantageous if you have too little debt. You want to have a certain amount on the books. So, different people have different ideas in terms of what a healthy current ratio is. I'd probably say anywhere, probably in the region upwards of 1 to, 2 or 3, I'd probably say is the norm. With that also, we have the concept of what's called a quick ratio, which is similar in nature, but it's just in the numerator there, it's just the cash and the accounts receivable, okay, over the current liability. So, your quick ratio oftentimes will be, obviously it'll be a little bit smaller than your current ratio because, inventory is not included in that. But again, it's a good metric to see if we have enough funds on hand or assets on hand that are going to be turned over into cash shortly to pay those current liabilities. Okay. In terms of some important terminology, Oftentimes in business, you'll hear the expression that cash is king. And this is just a simple expression that refers to how important cash is to the organization. The objective of any business is to basically quickly as you can convert your services or your inventory into receivables and then into cash. Okay, so that's the objective. As quickly as possible, as many turns as possible as we can do during a year. That's advantage to the organization because we want to keep on generating that profit and keep on generating more cash. Okay. The next account on the balance sheet you'll oftentimes see is your accounts receivable. Okay, so what this is in reference to is that many organizations that are kind of referred to as B2B, selling between business and business. Once organizations do business with one another for a period of time, and they establish a working relationship with one another, oftentimes they'll start conducting business on what's referred to as open terms. Okay, so that term, open terms, occurs, when a organization will have a credit department, and that credit department is going to be responsible for evaluating the credit worthiness of all of its clients, okay, to make sure that their clients are in good shape financially, that the business is healthy, so that if we execute a sale to this business and we execute the sale by extending them credit, that we can feel safe that that client is going to pay us back on that receivable within a certain time frame. Okay, so common for many businesses, they might extend net 30-day terms. So that all that means is that, okay, I'm selling you this particular product and I'm going to give you 30 days to pay me for this product. Okay, some organizations might extend that out a little bit. They might extend it to 45 days or 60 days, depending upon how credit worthy the company is. That's something that will take place in the negotiation process on the contracts. Okay. In terms of the breakout of accounts receivable, this is a common layout of receivables that we'll see. You might have a standard account receivable account to recognize all the assets that are generated for just all your standard customers. Okay, any external business partner to the organization will be booked into this standard trade receivable account. If you're working for an organization and there's many kind of sister companies within the organization, they're different legal entities, but they all roll up into one kind of corporate parent. And if those businesses conduct business with one another, you might have a intercompany receivables account, okay, just to kind of keep it from being commingled with the standard trade receivable, which can be useful for analysis purposes. Okay. Then finally, you also might have an international receivable account. So this would be, if I'm a company here in the United States and I'm selling, I have a large presence here in the American market, but you know what? I'm starting to expand and I'm starting to execute sales over in Europe and sales over in China and so forth. I might want to set up those customers' accounts so their activity gets funneled through an international or a foreign receivables account. So I can kind of keep a special eye on those receivables because typically they're viewed as being a little bit more risky. Okay. Some organizations will work to insure their receivables with a third-party financial institution. And, those credit insurers are oftentimes interested if you have a large international presence, what portion of your receivables are in relation to foreign entities. Okay. Another thing that businesses will keep an eye upon as it relates to their accounts receivable is the aging of the receivable. Okay, so the receivable aging is very important, and typically the receivables are going to be analyzed in buckets. Okay, so invoices and so forth that are 1 to 30 days old, that's a comfortable time frame. If the lion's share of my clients are on net 30-day terms, if all my receivables are between 1 and 30 days old, that's great because all my accounts are current. Where concern starts to enter in the equation if you start getting a lot of receivables that are in excess of 30 days, if they're 30 to 60 days old, 60 to 90 days old, or over 90 days old, then that's when the concern starts to mount. Okay, so many organizations, again, you'll have a credit or collections department, and they're paying special attention to any receivables that are getting in excess of say 30 days. So that's when they'll start doing collection calls and making sure that the accounts payable department at your customers know that these invoices are due and we expect to get payment here in a timely manner. Okay, because the older that these receivables get, especially if your customer is their credit is shaky, that's when you can start getting into trouble. Because if you have old receivables on the books, now Lord forbid your customer goes into bankruptcy, you're probably going to have a difficult time collecting on that, and you have to write it off. Okay, which kind of segues me into my next point here. Sometimes right in the balance sheet there in the accounts receivable section, you might see an account referred to as the bad debt reserve. So, if you're in a business, a large business in particular, oftentimes the finance department will take a look at the overall composition of their receivables and make an estimate based upon our history, based upon the credit rating of all the people that we're doing business with here. What do I anticipate having to write off here due to a bad debt? Okay, and they'll put a reserve on the books for that, just to kind of give auditors and management a estimate of, okay, this is our current receivables, but this is what we probably anticipate writing off. Okay. Then the last point here on this slide in terms of important lingo, what does it mean when an organization issues a credit, from a strict finance perspective? We've all encountered that situation before. Maybe you're doing business with a company and they ship you a bad product. So you call their customer service and say, hey, this product that you shipped me, this was defective, or you shipped me the wrong product. Oftentimes the person on the other end of the line, oh, I'm so sorry. Here, go ahead and ship that product back to us. Here's your return material authorization. We're going to go ahead and issue you a credit for those goods. So basically what that means is that the company that you bought the product from, they currently have a receivable from you, okay, on their books, or maybe if you paid them cash for it, they have the cash. So basically what they're doing is crediting the open accounts receivable to basically remove that liability off your books, or they're crediting their cash account because they're issuing the cash back to you. Then in part they're reversing the revenues that they generated on the sale. Okay. Next item on the balance sheet here is our inventory. Okay, so basically inventory is any product that is purchased and or manufactured by an organization and then sold in an effort to generate profit for the organization. Okay, so when you're taking a look on the inventory section of the balance sheet, it might be further divided into the following categories. If you're a manufacturing organization, you might have a raw materials account. Okay, so these are any goods that are purchased, then subsequently consumed in the manufacturing process in the effort to manufacture intermediate or finished goods. Oftentimes you'll have a packaging account. So these could be an account that captures all the boxes or packing peanuts, bubble wrap, anything that goes into the process of packaging the goods and preparing it for shipment. You might have a ledger account for intermediate or subassembly inventory. Okay, so this would be a product that is manufactured but it hasn't been yet converted into a finished good. So, say I'm an organization, maybe my organization makes soups. Okay, so I might have an intermediate product to represent a huge kettle, 500-gallon kettle of soup. Okay, so that's my intermediate product that in part will be consumed in the process of making my finished good, which might be soups packaged out into 8-ounce or 16-ounce containers. That's the finished product. Okay, that incorporates both the intermediate good as well as the packaging. Okay, so that's a common composition of that. Okay. Um, Finally, in here for inventory, another important thing to understand is with respect to the valuation of your inventory. So your company the finance and operations department is going to have a policy in place to indicate how we're valuing the inventory. The inventory can be valued on a standard cost basis, which is a basis that where at the beginning, say, of the fiscal year, the management team sits down and says, okay, based upon the current market prices of the raw materials, based upon the current what we anticipate paying out by way of wage rates and everything, this is what we anticipate these goods costing us. Let's go ahead and establish a standard cost for that. And basically any inventory movement that takes place for those goods throughout the year is going to be transacted at that standard cost. Then if you have any variance or variability between the standard and the actual cost of the good, that's all going to be realized as a period expense in a purchase price variance account or a manufacturing variance account. Okay. Alternative valuation methods can include average unit cost or lot costing bases. So, the average unit cost basically takes a look at all the stock of a product that you presently have on hand, what you purchased that product for, or manufacture that product for, divided by the total quantity of that product that you have on hand. So it's just an average per unit cost. The lot cost it's kind of a finer level of detail whereby you basically keep track. If you do lot control of your products in your computer systems, basically you're keeping the cost of each of that good for each individual purchase receipt or work order receipt that you've made. Then finally we have a FIFO and LIFO. The FIFO represents first in, first out, whereby the LIFO represents last in, first out. So basically with this methodology, you're keeping track of what we call costing tiers. So, anytime you receive this inventory into the system, you're establishing a new cost tier for that product. Then as you turn around and issue that product out of your system, whether it be consumption of that product on a work order, in the context of a raw material, or the shipment of that product to a customer in the context of a finished good, when that inventory gets decremented out of the system, your computer system will basically take a look at what the oldest, in the context of FIFO, what your oldest tier is, and issue it out at that cost. For LIFO, it goes to the bottom of the cost stack and issues it out at the most current price. Okay. So to illustrate those different valuation methods, I put together this little, spreadsheet here. We have a example item here, item 101345. The management team at the beginning of the year says, based upon, current market prices, I anticipate this good costing us about $1.30 per unit. Okay. So that's the item and that's the standard. Now, we go ahead and start transacting. This is, say, a purchase product. We start executing purchases for this good and bringing the product into inventory. So we have a purchase in January where we bought 100 units of it at $1.25. In February, we bought another 100 units at $1.29. In March, we brought another 100 units for $1.32. Okay, so now we have all that inventory in stock. Now, take a look here Let's say now we're turning around and shipping this product out. Okay, so when we when we ship the product out, that's when we're going to recognize our cost of goods sold, and we're going to decrement our inventory. So take a look. We have journals laid out here: standard cost method, average cost method, lot cost, FIFO cost, and LIFO cost. And you'll notice here the variations aren't huge, but there is some variations. Under the standard cost method, we say here we're shipping out 125 units. So in that case, I took 125 and multiplied that by my standard cost of $1.30, and that's what gave me my $162.50. Under the average cost method, I generated an average cost. I said, okay, my total cost of the product is $386, and divided that by 300, the total number of units on hand, and got a per unit average cost. Multiplied that by the 125 units being sold, and you can see in this case it's a little bit less. Okay, it's only $160.83. Okay. Same idea for the lot cost. In this case, it was, lot specific. So in this case, I sold 125 units again, sold it out of 100 units out of my first purchase, an additional 25 out of the next one. So when I go ahead and do the math on that one, I get my 157.25. Under my FIFO basis, I get the same one because my physical inventory flow followed my cost tier flow in this case. But you can see under the LIFO method, my costs are higher here because under my LIFO, we're executing our sales first against the last tier, which would be this tier in March, which is $1.32. Okay, most of the then we sold 25 units out of this cost tier for $1.29. So you can see under the LIFO method, being that we're in a period of escalating cost, it was the largest cost of all these different methodologies. Okay, so that's going to conclude our lessons here for today. If these videos of value to you, please remember to like and subscribe, and please tune in back tomorrow as we continue our review of the balance sheet.